The Morgan Report with David Morgan.
David Morgan with you with Money and Metals for the week of 9 May 2016. Well, let's start off on the currency boards here and talk about an article that came out of Reuters Tuesday. Global financial instability a risk with or without preeminent U.S. dollar, according to the BIS, Bank of International Settlements. The U.S. dollar's overwhelming position of dominance in the global financial system poses risks to world financial stability, but it's not clear that a more diversified arrangement would be any safer, according to the Bank of International Settlements. They said that on Tuesday. The global system's biggest weakness is its inability to prevent the boom and bust buildup and unwinding of hugely demanding financial imbalances, says Claudio Borio, head of the BIS Monetary and Economic Department, in a speech he gave in Zurich. If I mispronounced your name, I apologize. And at the other end of the spectrum, Damascus struggles to halt currency collapse as peace hopes erode. If you go back into the Damascus pound, what you'll find is the currency is worth 47 to the dollar on the eve of the civil war, and it now trades around 635 to the dollar in Damascus, and even higher rates in other cities, having fallen 20% in less than a month, according to currency dealers. Central bank governor said on Wednesday he would do what it takes to halt the fall. Good luck with that. So I think we're looking at a system now in the currency sphere that is very unstable, even with the BIS admitting such. And things are going to get, in my view, far more volatile as we proceed into the future. Doesn't mean that there won't be some huge opportunities between currencies. However, at some point, you will start to see gold perform not only in all currencies, but preeminently against the U.S. dollar. So now I'm going to move into some gold news. As I've reported earlier, gold had the best first quarter it's seen in 30 or 35 years. However, it didn't stop the gold miners. They boosted their hedge book in the fourth quarter, keeping hedging in 2016. The global gold hedge book grew by 18 tons in the first quarter. An industry report showed again on Tuesday. Miners use hedging by selling future production forward to guarantee returns on their output, which from my perspective is it's okay. I don't have anything against hedging. I just find it interesting to hedge at these prices, but we did have a pretty good run in the first quarter. But remember, I'm talking about the fourth quarter of last year. Should this appetite be sustained throughout the year, we would expect net hedging to be the outcome in the order of 40 to 60 tons for the year. The mining industry returned to net hedging in 2014 for only the second time in 15 years as prices fell. Something to look at, especially if you own the miners, who's hedged, who isn't, who has the most upside, something we look at very closely in the Morgan Report. Turning our attention onto the silver market, both the new silver studies have come out recently, CPM Group out of New York, and from the Silver Institute, the World Silver Survey. A synopsis of the World Silver Survey states, demand for silver reached a record high of 1.17 billion ounces in 2015, according to the Silver Institute. Pushing the total higher demand was jewelry by consumers, coins and bars by investors, and photovoltaic usage by industry. Demand for coins and bars rose to 292 million ounces, up from 236 million ounces the previous year. Average price for 2015, no surprise here, $15.68, down 18% from the average price of $19.08 for the year 2014. The Silver Institute report cited the lower price of the metal leading to higher physical demand. The scrap supply of silver declined 13% in 2015 to 146 million ounces. This is the lowest figure since 1992, and the Silver Institute said this is due part to collectors holding back supply, awaiting higher prices. Silver supplies from all sources, mining to scrap, fell short of demand by 129.8 million ounces. And if you saw our webinar, Is There a Silver Shortage? We explained that in more detail because actually the stocks of above ground silver have been building from 2006 onward. The point that the Silver Institute is using is the 130 million ounce deficit takes into account investment demand. It's not looked in the same way from the CPM report, but we will be looking at both reports and analyzing them for our readers of the Morgan Report in the June issue. And that will wrap up this week's Money and Metals.